welcome back. It is 15 minutes moving up to 8 o'clock. In our final segment, we have our friends from the Unit Trust Corporation of Trinidad and Tobago. Today we focus on common financial mistakes people make and how your financial advisor can help you to solve these problems on a sustainable basis. In studio, we have our Client Relationship Managers, Omar Holder and Ryan Brown. Thank you for joining us this morning, gentlemen.
Thank you.
All right, let's start with Ryan, since he's new. Swim in the hot water. What are common financial mistakes that people make in Trinidad and Tobago?
Well, some of the most common mistakes made in Trinidad and Tobago by investors are having too much debt, not prepared for impact of critical illness, starting to save too late for university education, that is, and not seeking assistance from a financial advisor.
All right, let's start with the debt part. Amassing too much debt. I mean, that could mean so much to so many different people, right, given people's different financial circumstances, the different ages, the different income. Let's try to focus that a bit.
Okay, when it comes to debt, one of the major issues is not having too much, as Ryan had alluded to. You want to keep the debts that you have maximum 40% of your monthly income. For those who have a mortgage, you might push it to 45.
And there's good debt and there's bad debt.
Agreed. So the good debt would be debts that you take on for assets, because assets put money in your pocket. Exactly. The bad debts are debts that you take on for liabilities. Liabilities, exactly, take money out of your pocket.
All inclusives.
Focus on the good debt, exactly. So another point that Ryan had alluded to with one of the common mistakes is retirement, because retirement and debt goes hand in hand. If you have too much debt, you might not be putting aside as much as you need to retirement. And of course, we always advise start as early as possible, because when it comes to retirement, one of the common mistakes we find people make is thinking of retirement in terms of time rather than paychecks. So most of us start work 20, 25. We end work 60, 65. If you save from the very first paycheck to the very last, you would have saved for 40 years. You get a paycheck every month. Max you have is 480 paychecks. So start as early as possible.
Can I add to that list of mistakes you make, not understanding that no matter how much you make, there's an opportunity involved there to invest or save, Ryan?
Correct.
Let's explore that a bit. And sometimes that's a bit daunting for people, because in their minds, when I'm working paycheck to paycheck, I can barely cover my expenses as it stands. But you really need to reorganize your process and start paying or investing in yourself. Just like how you think Mr. Courts or Mr. Standards or Mr. whoever has to get their share, you also need to get your share, don't you?
And also, to add to that, I think a lot of people don't seem to realize that, in particular, risk. Men and women, men in particular, have, they tend to live a lot shorter after retirement than women. So what tends to happen, women find themselves in a situation where they haven't prepared for that longer period of life after retirement. And that's just something that we need to take, it's necessary for them to be aware of as they go through that process of retirement.
There's a question that was posted to our Facebook page when you visited last, and it's a situation that we had not covered yet. When there's one breadwinner in the house and there's another person who's listening to all this, who may be a housewife or caretaker for children, who may not have a steady income themselves, but want options through whatever their husband or their wives may give them, etc., etc., because that's a real situation for some people. What do you suggest for them?
Most important, budget. Budget has to be critical in that situation. If there's one breadwinner, the other person has to be very conscious of money going out and money coming in. Every single month, track your expenses. From the smallest thing, it could be purchasing doubles, to the largest thing, paying the mortgage. You have to be on top of that at all times. And when life changes, include those in the budgets, because sometimes some people have the budget before the last child. The new child comes, the budget remains. It has to change, because now you have increased costs of diapers and formula and so on.
Let's talk about how a financial advisor can help, because sometimes we, as last resort, we're hitting rock bottom, and then we go to the financial advisor, when we should actually be approaching the financial advisor at the start of your working life, which is the best time for them to point you in the right direction, where you have many, many more options available to you, including the option of time.
Well, our process basically will help you organize and track your finances, create a financial plan, and help you stick towards it. Monitor your progress towards your goals, and adjust your financial plan as life changes come around. What we've been mentioning also, education, which we haven't really touched on just yet. US and Canada particularly, universities, education inflation rates from 1985 to currently right now It's roughly 500%. That's a big jump in inflation for tuition. Basically, what will help you along those lines of education, help you determine the cost and length of time the program will run for your child's education, basically. How much the program may increase per year, how long the child starts the program, and how much should you set aside for that process. And that's basically what we can help you along, and specifically to education.
How important are the words, "I cannot afford that," in someone's financial life? Because very often we don't realize the power in those words.
Correct. They are important for two reasons. One, it gets you focused. It can actually help you separate needs from wants, which is critical in financial planning. And for another reason, it can also help you become realistic. There are many different goals that people have out there, and sometimes it can be confusing, the number of products that you're inundated with. So we would want people, if you use that statement, to take an overall approach and a coordinated approach to planning. And that is why this new financial service that we are part of takes that overall and complete look at someone's portfolio. And then that also helps the investor decide, well, is this right for me at this time in my life? Is it not? And you tend to find too that persons who seek the advice of an advisor, particularly when you ask yourself that question, they generally become more prepared, they are wealthier, and they tend to be better prepared for the life circumstances of critical illness, a new child coming, or retirement.
How important is, even if one didn't do it at the start of one's work life, going to a financial advisor upon the onset or just before these major changes in one's life, when you want to buy a car, when you want to buy a house, when you have a child or planning to have children, when you start thinking of retirement, which should be at the start of your work life, Ryan?
Well, anything helps, basically. It's, at the end of the day, you're gonna need some help no matter what. And it's better to actually make the effort to get forward and do something about it.
Is it foolhardy to think you can figure it out on your own? Given the complexities of financial life these days, the changes in the markets, the changes in everything?
I wouldn't say foolhardy, but I think it's necessary to have at least advice from someone else outside of your own train of thought.
What's the financial planning process? Let's just go through that.
Well, basically our process, we establish the relationship with our clients. And we gather client information and on their long-term and short-term goals. Analyze and evaluate their financial status. That's what we've been mentioned earlier with the debt per se. Develop and present a financial plan. Implement the financial plan and monitor the financial plan as we progress throughout your life.
How are risk management strategies factored into that, given the fact that life is very dynamic?
Correct.
And major changes can happen in a snap?
Your particular risk temperament or tolerance is critical in the overall financial plan. If you prefer to, as we say, eat well, you're going to have to take on investments with a greater level of risk that could possibly provide a greater level of return, so you can have a higher standard of living. If you prefer to sleep well, then investments that are more stable will be better for you, because there are some people there are some people who worry at night because they have placed their funds in an investment that could possibly generate a high return, but then it could be more volatile. So for them, instrument that can provide the safety that you need, the interest rate that you need, and the access to your money that you need.
Let's draw three scenarios. One, somebody 23 years or 24 years, just finishing college or tertiary level education, starting their substantive work life. Two, or B, somebody in their 30s, 35, thereabouts, middle of their life, possibly now getting a house. And four, somebody 50 to 55 now knowing that they have 10 to 15 years left to work. Let's start with the first person, Ryan.
Well, at that age, 25, you are in a position where you can take a little bit more risk onto your portfolio than someone that's 50, 45, 45.
So those instruments that should be available are?
Well, some of our equity funds in particular. You may want to take a risk and go into a relatively high risk equity fund, such as the energy fund, the Latin American fund, Asia Pacific fund. These are funds that are relatively risky based on the
when we hear those names, sometimes it scares us. Should it scare us? Because you hear, wow, I'm moving out into the big wide world of investment. Is it that difficult, or you know, what are the risks and what are the advantages?
It really isn't much of something that should scare you, because it's these assets the stocks that we're investing in are basically household names that you're more or less aware of and familiar with, companies that have products that you buy on a regular basis. So it's a matter of commonality. Just they understand what the products are basically, and they will see what exactly is on the portfolios, so they have an idea of where they have an idea of what they're invested in.
And those are a little more volatile than some of this, or are they as stable as the medium to short term?
Correct. They automatically will be a lot more volatile than for example, the growth and income fund, the universal retirement fund.
Omar, the second scenario, 30 to 35 years old.
Correct. So in your 30s, house, it's definitely one in your life stage, maybe a child or two. So you're beginning to prepare for children's education. You still want to put aside money to retirement, but age is a good guide throughout. And age gives a good guide of how your assets should be allocated.
And how many paychecks you have.
Correct. So in your 30s, you have 30 more years to go. You have a paycheck every month. You have 360 paychecks left. You must put aside for retirement. And Ryan had alluded to the increased cost of education and so on. There is no scholarship for retirement. So we tell everyone in their 20s, 30s, and 40s, ensure that you still put aside something for retirement. The types of funds you should use in your 30s, about 30% of it should go into the 30% of it should go into the short-term instruments, because you need access to a little more money, because you have to pay school fees and drivers and lessons.
Get ill sometimes.
Correct, exactly. But still, the bulk of it should be in those longer-term instruments that Ryan alluded to.
To give you security down the road.
Correct.
And now the person 50 to 55, you have 10 to 15 years left in your work life productively.
Correct.
You may look a little longer part-time, but generally,
yes,
you have less paychecks left.
Exactly, one less paycheck. So hopefully you would have been saving from earlier, but then you need greater access to funds. Why? Because at 50, the mortgage is now starting to be paid off. You might be finishing up paying for the last child in university, but you're getting ready to leave the working world. So most of, about 50% of it, we'll say about half, should be in an instrument that you can easily access, but the other 50%, you still have, if you're 50, a good 30 years on the planet, you should still get that growth.
And you need to also have access, because your health issues will become more prevalent.
Exactly,
also,
particularly after retirement. And then in retirement, at the end of the marathon as such of your career, you need to have easy access to your money, safety of your money, and then you need an interest rate, that provides growth and interest that you can live after. Because we say at retirement, there are 3 sources of income that you need. 1, lump sum payments to fix the roof for the last time, to possibly buy your last car. You need a salary every month, because you still have to make expenses. Exactly. And then you need to have money in growth instruments to leave for those who are coming behind you.
All right. Gentlemen, thank you very much. We've been talking to Omar Holder and Ryan Brown, both client relationship managers at the Unit Trust Corporation and TTUTC.
/financial advisor. You can find out more.
Financial advisor, you'll find out more. That's our show for today. Thank you so much for viewing this morning. We want to invite you to join Disha Ramachan, James Saunders, and Ian Wallace tonight at 7 o'clock for our major news, and check out our interactive website with video on demand at ctntworld.com. Have a great day. Join us again 6